Chapter 8, Business Organizations. Discussion number 3, Forming Corporations. At first, the charts that I want you to see, are a comparison of corporations, partnerships, and sole proprietorships. And what we see, first of all, the left-hand circle, is that a vast majority of the businesses in the United States are sole proprietorships. There's a few that are partnerships, and then there is corporations. But if we take a look at the revenues, we see that the corporations bring in over 85% of the total revenues. And so corporations, simply by these circles, show us they are an efficient method of producing large businesses capable of collecting large revenues, whereas sole proprietorships and partnerships do have limitations on what they can do and how they can function. So let's take a look at what exactly is a corporation. Corporation is an organization owned by many different people, but is considered legally, for taxes and for legal actions and for property, as an individual, which means that they can own property separate from their owners. It's going to be important. They are taxed at a higher rate in return for this special consideration. If a corporation goes bankrupt, sell off all the assets, whether it is buildings, tools, patents, whatever you've got, sell it off. If the corporation still owes money, it does not go back on the stockholders to produce more cash in order to satisfy those debts. Remember that sole proprietorships and partnerships both said that if the bills were too much, the people individually would be responsible for those bills, not with the corporation. And because of that specific consideration, corporations do tend to be preferable when corporations start getting large. And when these businesses start getting large and the bills start getting large, this is a way that owners can protect themselves from large problems as well. Now, in order to buy into a corporation, you buy a stock or a share of the ownership in the corporation, which entitles you to future profits, assets of the corporation, and also the opportunity to have a say in what happens in that company by a vote in stockholders meetings. Now, corporation liability is limited to the investment of the company. If the company goes completely bankrupt, the money that you put in by buying a stock is the sole amount of money you can lose if the corporation goes bankrupt. Again, you cannot lose any more than that. So, when you're starting a corporation, first of all, you need to register the company with state authorities. We don't do federally registered corporations here in the United States. You register with a state in itself. Delaware is very popular due to the lack of taxation in particular methods. So you need to have, when you register, a name and address and a purpose of the corporation. You need the name and addresses of the proposed startup board of directors, which can change later, but these are the board of directors as initially selected by the partners of the corporation. You need to tell the state how many shares you intend on selling on your initial public offering so that people have the opportunity, so they know how much money or how many shares is this company going to be divided into. And based on that and what price you're planning on selling your initial shares, you'll be able to tell them how much capital you're intending to raise. Now, if you are approved by the state, then you will receive a corporate charter, which essentially is a license to operate that corporation in the state and that you are allowed to exist. Remember, because the state and also the federal government give that extra special consideration of separating the liability from the owners and the corporation, is that the state does have a vested interest in to make sure that people are behaving themselves in what they do. So when you sell stocks, more often than not, you are going to sell what is categorized as a common stock. This is where a stockholder receives actually a percentage ownership of the company. Now, before you get all excited when you go out and buy Walmart on the stock market tomorrow, which actually it's going to be hard to do because of the fact that most of you are not allowed having credit cards and you wouldn't be able to do a stock trade for Walmart based on that. Anyway, when you go buy Walmart, don't get all excited that you can start bossing the Walmart family around, because there are literally millions of shares of stock of Walmart out and available. So, but common stock gives you a vote in the company business. And it's not one person, one vote. It's one share, one vote. So if you go out and buy your one share of Walmart and then someone in Wall Street has 100,000 shares of Walmart, your vote gets counted once, their vote gets counted 100,000 times. Dividends may be granted. Now, that's simply the stockholders' share in the company profits. You're not guaranteed to get a dividend. There are corporations that have still not issued a dividend even though they have been around for 30, 40, 50 years. So, but dividends, well, what happens to those corporation profits then? Well, a lot of times those profits are put right back into the company for research and development or for other expenses or to build up some type of savings account so in case they do have problems later, they can use that money. So dividends are not guaranteed to be granted. A lot of times the corporation will decide that they're going to make other uses of it. However, if they do decide to issue a dividend, then that will be issued to all stockholders. And again, don't get too excited about this. Most time dividends are measured in 10 cents, 50 cents. Now, whoop-de-doo, but remember, if Walmart's got millions of shares out there, those 50 cents turns into 5 million, 50 million real quick. So, yeah, that's what the corporations kind of run with. Now, there's also a categorization of stock called a preferred stock. And now, preferred stock most times does not have voting rights. So they don't get to tell the corporation what to do. But when they're called preferred stock, it means primarily that they are guaranteed that they will get dividends. And also, it can be in the preferred stock that they get the first rights to the assets or the cash from the assets if the company goes bankrupt and they need to sell off what they have. Now, as with common stock and preferred stock, these are generalizations that are generally followed. A lot of times, especially with the preferred stock, it's going to be very specific of what exactly is and is not going to be included. These are just some examples that I have listed here for those preferred stocks. What is generally trading on the stock market, though, is common stock, not preferred stock. And so when you look up in the stock market and you see such and such a company is trading at such and such a price, you are looking at common stock price, not preferred stock, unless there's a special designation there on the ticker symbol. This concludes discussion number 3, forming corporations, as part of Chapter 8, Business Organizations.